Old money does not have a stock screener. They do not watch the market open. They do not rebalance quarterly. They do not follow financial news, track their portfolio weekly, or spend Sunday afternoons researching their next position. Most of them could not tell you what their portfolio returned last year within 10 percentage points. And they are wealthier than almost everyone who does all of those things obsessively. This video is going to make you question every assumption you have about how wealthy people actually build and keep their money, because almost everything you think you know is wrong. And the real answer is so simple it is going to make you slightly annoyed that nobody told you sooner. What they actually own. Old money does not own stocks the way you think of owning stocks. They own stakes. Long-term, permanent, never-to-be-sold stakes in things that generate income continuously. A minority share in a business that has been running for 40 years. Property held through a family structure that has never been listed for sale. An allocation in a fund that was set up before they were born and will continue running after they are gone. The key word in all of that is never sold. Old money does not trade. Trading costs money every time. Tax on gains, transaction fees, the spread between buy and sell price. The opportunity cost of being out of the market between positions. Old money stays in the market permanently and lets the market pay them continuously. The return is not from buying low and selling high. The return is from never selling and collecting income while everyone else is busy buying and selling. The buy, borrow, die strategy. Here is the specific mechanism that old money uses that almost nobody outside the wealth management industry ever hears about. They do not sell their assets to access cash. They borrow against them. When you own 5 million euros in assets and you need 200,000 euros for something, you do not sell 200,000 euros of assets and pay capital gains tax. You go to a private bank, show them the 5 million euros as collateral, and borrow 200,000 euros at a very low interest rate. Your assets keep compounding. You never trigger a tax event. You spend the borrowed money, and when you die, the debt is settled from the estate at a step-up basis that can reduce the tax bill significantly. Buy the asset. Borrow against it when you need liquidity. Die holding it. The asset compounds your entire life. The tax event is minimized or deferred. The wealth transfers to the next generation structurally intact. This is not a loophole. This is architecture, and it has been running in certain families for 100 years. Why they do not panic. When the market dropped 30% in 2020, old money families did not sell. Not because they are emotionally disciplined in a way you are not. Because the structure of their holdings makes selling almost impossible without significant cost. Assets held in family trusts have governance requirements around selling. Property held through company structures has transaction costs and tax implications that make a panic sale enormously expensive. Legacy positions in private businesses have no liquid market to sell into. The structure itself is the discipline. They are not relying on willpower during a crash. They are relying on a legal and financial architecture that makes staying in the default position and getting out the difficult one. You can replicate this principle at any scale. Set up automatic investing and make stopping it require deliberate effort. The friction of reversing the process is the protection. The advisor relationship. Old money does not follow financial influencers. They have one advisor, sometimes a firm, sometimes an individual, who has managed their family's money for decades. Who knows their structure, their goals, their tax position, and their generational plan. That advisor is paid a flat fee, not a commission on products sold, not a percentage of returns, a fixed annual retainer for managing the relationship. This matters because a commission-based advisor has an incentive to recommend activity. Buying, selling, switching funds. Each transaction generates revenue for them. The flat fee advisor has an incentive to do the opposite, to hold, to minimize activity, to protect the compounding. The advice you receive is shaped by how the advisor is paid. Old money has always known this. They structured the incentive accordingly. What this means for you. You do not have a family trust or a private banker or legacy positions in a company your great-grandfather started. But you can apply every principle in this video at your scale right now. Buy index funds and never sell them. Hold for decades, not quarters. When you need liquidity, explore whether borrowing against your assets is cheaper than selling and triggering tax. Pay your advisor a flat fee, or use a platform with no commission structure. Automate your contributions and build friction into the process of stopping them. None of this is complicated. All of it is available to you. The only difference between you and old money is not the amount, it is the time horizon and the commitment to never interrupting what you start. Old money is not smarter than you. They are less busy with their money than you. They found something that works. They set it up correctly once, and then they left it alone for generations, while everyone around them was buying, selling, switching, optimizing, and ultimately building less. The investment strategy that built the most durable wealth in history is not exciting. It is almost embarrassingly simple. And the reason most people never follow it is not because they cannot. It is because simple does not feel like enough when you are watching other people do something that looks more sophisticated. The most powerful investment strategy in the world is the one you set up once, automate completely, and then do almost nothing with for 30 years. Old money did not discover this recently. They have been doing it since before you were born.